Welcome back to Arise Exchange for this Monday. As we mentioned, the second half of the year has begun, and it could be out with the new, in with the old, meaning emerging markets might see a turnaround. We'll see. To talk about emerging markets and the latest on the U.S. Fed and the markets in general is Jonathan Satovsky from Satovsky Asset Management. Welcome back to the program.
Thanks for having me.
So you were here just a couple weeks ago, and boy, what a difference 2 weeks means, especially if you have short-term horizons. Walk us through what has happened and where we're headed, do you think?
Well, clearly things change in a New York minute. So 2 weeks ago to now, we've had a Federal Reserve meeting, and hints of Federal Reserve tapering or slowing down on bond purchases has roiled global markets.
Boy, has it ever. Since May 22nd, the markets have just tanked. All asset classes are getting demolished.
Absolutely. So traditionally, people diversify all around the globe, and virtually every asset class in the world declined in a 2-week period. So it was quite a dramatic reaction to what was happening. And going forward, the preconditions of why, as we talked about before, why are they tapering and what are the repercussions of their tapering? Are they tapering because conditions are really improving on the ground level, or are they tapering because they're worried about creating an out of control or hyperinflationary situation? And and how consumers and businesses and traders and investors all react to that is really going to have a trickle effect and impact everything down the line.
Now, your view is long-term. Your clients are sort of long-term investors, and long-term means different things to different people, of course. But when they call you up and they say, what is the Fed talking about? What do you tell them? Because you don't just have Ben Bernanke out there, but you now have a whole bunch of them sort of going off the reservation every day and saying whatever they want to say. Right.
Well, at the end of the day, a lot has to do with borrowing costs. We talked about this previously, where that people are able to borrow money, they're able to buy a home, they're able to get a loan for buying a car, student loans you were just referring to. And if interest rates rose too fast, I mean, we had a 10-week period where interest rates rose on the 10-year Treasury from 1.6% to 2.6%, the sharpest, fastest rise in history. So we had about $80 billion exit the U.S. bond market. And bond
we saw a bond market crash, they said, worse than the 1990s.
And you saw redemptions equivalent to what happened in October of 2008. So it was a very dramatic move. And many people on the more conservative end of the spectrum who thought they were buying bonds to be more conservative and safe have actually been more adversely impacted than people that were further out on the risk curve buying stock and owning equity in corporations.
So, of course, this all leads to the question of where you put your money. And I want to talk about emerging markets for a moment, Pierre, because we saw this huge sell-off for the year. But now there's some talk that the emerging markets might be coming back. Where do you fall in on this?
Well, again, think about investing as, gravity. Prices go up and prices go down. So in this culmination of these past couple of weeks, these past couple of months, you've had people exit in droves out of China, Brazil, Russia, India, Australia. All the emerging markets have gone down severely. If you take a 7-year approach and you're thinking out for a longer period of time, and you realize sort of the demographic trends as you see Obama going to visit Africa, opening up trade barriers, there is much greater growth opportunities in the emerging markets than there is generally domestically, and you see that even in earnings. European companies have a third of their earnings coming from emerging markets. The U.S. is trying to get on the action to be able to expand their borders, to expand trade, so that our corporations can benefit from this trend.
And even though China has taken a slight hit, its economy is huge, and the consumer spending power of China is huge, and they buy a lot of their goods from emerging markets like Brazil.
Absolutely. Well, I'll tell you something interesting. There's a school in Indonesia, in Bali, called the Green School. They are promoting innovation, and kids from all around the world are going to this school to learn to think for themselves outside of a traditional school setting. And they're graduating their first class in 2013. And these kids have learned how to deal with third world countries, how to deal with a non-structured environment, and how to think for themselves and take on entrepreneurship. So if the banking system opens up all around the world, in China and in America, these people can look at the world differently and say, you know what, I have an idea how I can tackle this problem, whatever the problem is, whether it's electricity in Africa. And they go to that region and say, you know what, I have a solution. And they're thinking on a really singular level. And they get a loan and they start a business. And that is how entrepreneurship and capitalism works, where you're basically problem solving. And the more and more people take on risk, and the more that we're capable of funding that risk taking, the more and more that jobs will be created, the more and more that our whole society can increase their living standards around the world.
And that's the long-term view.
That's the long-term view.
All of this starts to come up. We'll have you back on in a couple weeks to see where we go over the next 2 weeks.
You got it.
Hey, Jonathan, thanks for stopping by.
Thanks for having me.
You are watching Arise Exchange.